Hey guys, it's September 23rd, 11:05. I finished trading for the day, and it's a green day, but not too happy with the way I traded. I started out strong, and then after like one failed trade where I was still way in the green. I mean, I shouldn't even taken that trade. But then, I tried to take another trade and recoup some of my losses. All bad things to do. And they're all things that I tell myself not to do every day. And I still find myself having trouble following those rules. And generally, what I do is I write down a plan every day, and I have some of those rules in there. And I find I stick to about 75% of them day to day. And I don't know what it is, just lack of discipline, I guess, when you're a new trader. Overall, I'm kind of getting better at following my own rules, but that's still the hardest part because I always look back, and if I would have followed my rules, so many more green days, bigger green days, things like that. So what I decided to do today, I've done this before, but this is a little different now, is I came up with 10-day trading rules for a choppy market, because that's pretty much where we're at right now. We're kind of at an all-time high. Things are really choppy, really volatile. The stocks aren't following through that well. So it requires kind of a different set of rules than I had a few months ago. So I thought I'd share those with you guys, because I know that if I follow these rules every single day, at least the way the market has been playing out the last couple of months, that I would be doing very well, be consistently profitable, rarely have a red day, and really increasing my account. Like I said, today I was up over 1.5%, and my daily goal is 1%, and then I gave back about 1%. So I ended up only up 0.5% on the day. And, that was just because I made some trades that really were against my rules. So I decided to put them down in a Word document. I'm going to print them out and read them every day before trading. That way they kind of sink in. And if I break them, I know what's going to happen. So I shouldn't be breaking these. So the first one is no pre-market trading. And mainly that's because in the pre-market you can't have stop losses or take profit orders in place. So I find that even when I get into a good setup in the pre-market, I tend to get out really early, because you never know when things are going to reverse against you, and I just don't feel safe without a stop loss, and my account's just not big enough to take a big loss in the pre-market and then bounce back during the day. So it's better just to not trade in the pre-market. Also, even when my trades win in the pre-market, they're very small wins, like I said, because I don't want to stay in them long enough. So I'm just kind of wasting money in my cash account that I could be using during the day. The second rule is only trade the 5-minute chart, and that's because the 5-minute chart has much more reliable setups than the 1-minute chart. It's as simple as that. The 1-minute chart can sometimes show you good patterns that you think, okay, this is a good pattern, I'm going to get in, and then it fakes you out. And that just happens, I would say 50% of the time on the 1-minute chart, you see a good pattern and it fails. Where on the 5-minute chart, it seems, I haven't actually run the numbers, but it seems to be at least a little closer to 75-80% of the time, good patterns don't fail on the 5-minute chart. And some patterns work better than others. So then the third rule is the absolute earliest that I can get in on a trade is a good 3-bar play setup after the open. So if you're not sure what a good 3-bar play setup is, I would look into Live Traders. That's where I learned the 3-bar play setup, and he has the safest rules in place for taking a good 3-bar play. So this is, again, to kind of keep me out of the real choppiness, and this would definitely be on the 5-minute chart, like I said in rule number 2. So this would keep me out of trading for the first 10 minutes, basically, of the open, which is good, because sometimes the stock rips up on the first 1-minute candle, and you want to get in and ride it on the way up, and then it just flushes out and never recovers. So you're going to miss a few times where they actually do follow through, but more often than not, they're going to fail. So it's better just to let those ones you miss go by. And then number 4 is never buy a 3-bar setup during the forming of the second candle. So that's kind of like, let's look at an example here. This was a stock I traded today on the SPY, and I actually broke that rule, and it kind of really screwed me on this trade. Pardon my language. I was looking over here. So let me back out a little bit so you can see the context. I'll make this a little bigger so it's easier to see. So you can see what happened at open. This thing kind of, now this was one that was trading up real high in the pre-market. Did this huge run in the pre-market. So it was at the top of the gap scanner today. And then at the open, it shot up, it broke the pre-market high, which was right here, and then it flushed down. So there's an example of why you don't want to get in on the first candle. This is the 5-minute chart, but which I said that's where I want to trade anyway. But just to show you what happened on the 1-minute chart, let's say you got in for the break of the 1-minute candle. If you didn't get out real quick, you were going to be at a loss, maybe a very big loss. So that's why the 1-minute chart is just not very good right now. This was the best stock to trade today, and the 1-minute patterns were pretty crappy. So anyway, that's why I was watching this to begin with, and yeah, this thing's ripping up right now, but it's too late now. And of course, there's no guarantee that ever happens for sure. But so I'm watching it over here. I'm kind of watching it recover, and I get interested at this candle. This candle's forming, and I see, okay, this is like the first sign of recovery, and we've got higher lows, and then this is like the very first bar of a 3-bar setup. Then I'm watching this candle form, and it's essentially never breaking the high of this candle, and it's a little red candle just kind of bouncing up and down here, and I'm like, oh wow, this is like textbook 3-bar play setup. I get my order ready, I don't put it in, and then as this candle's still forming, I break the rule of buying in during this candle. And what I normally try to do is wait till about so this is a 5-minute candle, wait till about 4.5 minutes have gone by, and then place my order in, and hopefully the price is down here somewhere, or just maybe a hair above this candle. But way before that, it jumped way up here, and that should have been a sign for me to not buy in, because that's not really a great 3-bar setup. If you were to buy in, you'd have to buy for the break of this candle. But anyway, I got in, and then this thing, started flushing down and down and down and down, and it never really came back up here, and I was in a loss the whole time. And when this candle started, it stayed below my entry. It never went up here till the very end of the candle. And I already felt like, what, I took this trade when I shouldn't have, and let me just take a small loss on it, which I did, and I got out, and I'm glad about that, even though this thing did rip up, because my entry was bad. I should have waited if I was going to take the 3-bar setup for the break of this high, and then I could have gotten over here. Eventually I traded this for the break of the high a day and got some profit. But anyway, that's an example of why that rule exists. Never buy a 3-bar setup during the forming of the second candle. And then 5, get out of trades early if you see price weakness. So that, again, that's because we're trading in a really choppy market right now. So so here's an example. So I got in for the break of the high a day, and I rode this up a little bit, and I think I got out around here, and I'm glad I did, because this thing really chopped out. Yeah, it did continue higher here, but this is not a very strong candle, and it ended up closing around here. So I took some decent profit there, and this thing didn't continue up, so that it ended up being a good play. And then 6 is always set the stop loss to the low of the previous candle. So that means, for example, if I would have bought in for the break of this one like I should have, the stop loss would be over here. And then you see, if I just kind of held onto this thing, I would be protected. I could bring my stop loss at each 5-minute candle. Here I'm already in the green. Bring it up over here, and I'm weighing the green and bringing it up over here. And then if I just left it there, I would get stopped out here for a really nice profit because I got in here at 424, and so it's all, like a little more than 25 cents profit per share. And see, never buy after the third green candle is formed unless it's a breakout through the high of day. So back to this chart again, you see that's kind of what I did here. If this wasn't the high of day, I wouldn't have taken the trade there because after 3 green candles, the stock is already overextended. I guess you could count this one, but I mean, this is kind of like the beginning of a little curl here. So technically this is the third green candle. But because this is consolidation, this is the first candle of a 3-bar play. So, there's a little nuance to it. And then 8 is never buy the backside. And again, I broke that rule today after I took some profit off this. Then I had like one small loss. This was really dumb. This was buying the breakout, trying to break new highs of day again. And I shouldn't have done it because of all of these green candles. And I did that, and I took a small loss, and then I tried to get some of the recovery. I think I switched to the 1-minute chart, which again I should not have been doing. That's why that's one of my rules. I switched to the 1-minute chart, and I think I bought in, where was it? Oh, yeah. So I watched all this play out, and then I bought in down here, thinking, okay, this is going to be the recovery. This is not a good play. And then I got picked up here for the break of these 2 candles, and then it flushed out and hit my stop around here. So that was really bad. Again, that's trading on the 1-minute chart, which I'm not going to do anymore. It's just a bad thing to do. You see, if I would have followed my rules, stayed on the 5-minute chart, I mean, look at this thing. There's a lot of good setups. There's another one for the break of the high a day. Here it's much better to buy it than over here because it had a small pullback. So it looks like this thing is even maybe suspended right now. It's a 9, only 10% position and a single trade, and that's just because even these good setups, they can go against you. So you don't want to think, oh my gosh, this is a textbook perfect setup. Let me just dump, twice my normal share size or half my account in there. What if it's the one time that perfect setup fails? Because it does happen. Then you're at a huge loss. You may blow up your account, or you may, spend weeks recovering from it. So it's just not worth it. Just stick to 10% and take what you can get from that perfect setup, and when it fails, it's going to give you a very small loss that's easy to recover from, probably in the same day. And then 10, this one's really important, is to never average down, and I should put never ever because it's that big of a deal. Averaging down rarely works, and when it does, it just kind of encourages bad behavior. Averaging down, or the feeling that you need to average down in a trade, is kind of like admitting that the trade is failing, but you're going to buy more shares anyway, which logically makes no sense whatsoever. I mean, it's kind of the definition of holding and hoping. Instead of getting out for a small loss, you're going to hold the trade, you're going to buy more, hoping that the thing is going to come back around and do what you wanted it to. That's really stupid. Just take your stop loss and then look for another opportunity. If that stock ends up turning around, maybe you got into it too early, you can get back in, especially if you're only taking 10% of your account on each trade. You're going to, even with a small cash account, you're going to have opportunities to get back in. You can do like 4 or 5 trades a day with your cash account if you're taking 10% share size. I'm sorry, 10% of your account as your share size or position size. So those are the 10 rules, and I can tell, like I said, if I just look back at all my red days, if I would have followed these rules, they would have been green days. My green days would be bigger green days if I followed these rules. So I made these. I'm going to print them out. I'm going to read them every day, and I'm going to hold myself to them, and maybe even punish myself by not trading the next day if I break one of these rules, even if it results in a green day. because these are that important. If you follow these in the long term, you may have to sit through some halfway decent setups that pass you by, but in the long run, this thing is going to save you money and make you money, because those halfway decent setups fail a lot more often than they work out. So you just want to stay out of those. The last thing is that these rules assume that you're trading stocks in play that have gapped up in the pre-market, that have good trading volume, appropriate float size, and are trending up on the daily chart. So that stuff, if you watch any of my watch list videos, I go through that every single day. So that's a part of it. So anyway, I hope these rules help you. Rules are extremely important. I call this channel Trading Armor, because rules are the armor that protects us when we're day trading in the market. All right, let me know what you think.